Good evening, ladies and gentlemen, or good day, wherever you are joining us from online. My name is Vincia Cloete. I'm the Executive Director of the Namibia Institute of Corporate Governance. Welcome tonight, and also welcome to my panelists tonight. I have with me Angelique Peake. I'm going to start introducing you and just tell the people about who you are. She's the head of coverage at RMB Corporate and Investment Banking since June 2019. And before that, she was the sector lead on mining and resources, also at RMB since 2014. And then before that, she was a business development manager at Barclays, London and Milton Keynes, is that correct? For 4 years. She has qualifications, a degree in BBA honors through UNISA, Diploma of Marketing Management, IMM, and Gibbs University Senior Management Program 2011. And then I have with me, welcome Angelique, I have with me Mr. Ishmael, and this is a tongue twister, but Mubwandarikwa. Yeah, that's correct. He's a doctoral candidate with emphasis in sustainability, ESG, the topic we're talking about tonight. And he's a seasoned trainer, lecturer, project manager, and business development consultant with a broad range of expertise. He has such a long, accolades, but I'm going to shorten it to say that he's worked for various universities, colleges, training centers, governments, and multidisciplinary research teams, and has recently been a lecturer at the University of Namibia. He is a doctoral candidate, like I have said, at the Namibia Business School, which is with UNAM. The research title there is developing a strategic framework for sustainability in listed companies. And that's basically ties really well with the topic that we have tonight. He has a Master of Leadership and Change Management at NAST. He has done a case study of Namibia in his master's, also a corporate governance master's that he's done. He holds other qualifications, and they include a postgraduate certificate in higher education at NAST, BCom at the Zimbabwean University, B Science at IUM, ND and NID at Polytechnic, when it was Polytechnic, and he's currently pursuing a PhD with the School of Governance at University of Witwatersrand, Johannesburg, South Africa. A lot that you have going there, but welcome on set.
Thank you very much.
And it's also good, not just a lot, it's good.
Thank you very much.
And then I have Steve Galloway. He's actually my chairperson at the Namibia Institute of Corporate Governance. He has 40 years of working experience in exploration, mining, government investments, corporate and project finance, banking and strategic management, and has served on boards of several financial and mining companies. And Steve retired from banking in 2017, but he still serves on a lot of governing bodies and helps us with his wisdom and, carrying over all that wisdom to us younger people. He's definitely on various boards of banking, ICT, tourism, environmental, community governance organizations, and on selected policy committees. So welcome, Steve.
Thank you very much, Vincent.
Right. So tonight we're having a closer look at the new concept, or actually I said it wrong. It's not a new concept. It's just a trending concept of ESG. It's not new in the sense that it's actually been promulgated or been propounded since 2000, I think, when, Kofi Annan started talking about ESG and so on at the UN and UN level. So ESG lens helps assess how an organization manages the risks and opportunities created by changing situations or conditions, such as the shifts in environmental, economic, and social systems. Some of these conditions have been identified, like I said, in the earlier versions of sustainability-focused strategy and regulatory frameworks, including environmental health and safety, which was known as EHS, corporate sustainability, which is still a key topic, CSR, which is corporate social responsibility, and now ESG, which is such a buzzing word in corporate governance landscape. In fact, today, Steve has just come out of a 24-hour global network of Directors Institute conference, which we all, well, the two of us at least attended. very good conference, and he spoke on this very topic, ESG. And I just want to start with you, Angelique, and ask, can you unpack that ESG, what it is, and can you also tie it in with CSI to just tell us, is it synonymous to CSI? Is it related to CSI somehow?
Yeah, thanks, Vincia. I feel highly underqualified between these two gentlemen, but let me give it a good go. So I think, as you mentioned, it's a buzzword at the moment. We nearly don't want to say that because it makes it just a trend, and it's not really. It's something that we all need to take quite seriously, and it's becoming more and more serious. Yeah. So I think originally ESG was a construct by financial institutions to assess non-financial aspects that could influence investment decisions or performance factors, etc. It's evolved a lot since then, right? So it's going into much more the three pillars, which we'll discuss at a later stage, I'm sure, but to get people to understand what is the right thing to do, not just from the factors that you mentioned earlier. Mm-hmm. You know, ESG and CSI, yes, are synonymous, but, you know, CSI is one of the factors of ESG. It plays very much into the social pillar. Mm-hmm. And CSI is very much more, you know, companies doing the right thing for the right reasons by their communities, etc., by their stakeholders. It's flown from all of the items that you mentioned into CSI, into sort of shared value, and now become this bigger construct of ESG. So CSI is, for me, more the license to operate from within the community for any company, whereas ESG is becoming something much more serious, measured, and very specific to how a company operates.
And both, you know, CSI obviously talks about corporate social investment, right? So both in the end talk about investment, and I think we'll come to a place where we're going to talk about investing and so
Absolutely.
on. I think there's that element of investing in society, in environment and so on, that is a similar factor between the two. And you know that you've just mentioned the three pillars, and that leads me to my next question, which, you know, socially conscious investors use the criteria to screen potential investments, and we're talking investments now. Mm-hmm. So let us unpack those three pillars of ESG with examples, if you can, Ishmael.
Okay, so if we look at ESG, I think it's very important maybe to look at its magnitude in terms of value, because it's more or less talking about value. I just want to quote a bit here, what Bloomberg has just reported, to say it is estimated that global ESG assets are expected to reach $53 trillion by 2025, right? Which is more than 30% of the $140.5 trillion assets under management. That's a lot. So which means people are giving credence to these pillars, to these dimensions of the environment, of social, and of governance. And I'm glad your institute, as an institute of governance, is taking credence and recognition of ESG. Why? It's because if you see the mega trends of most businesses, they're transitioning towards really taking ESG seriously because of its impact. I like what she said, to say, you know, when we look at CSI as a small component of the social element or dimension, it actually gives companies license to operate within the communities that they are operating from. So what's important to note is, when we talk of the three pillars of ESG, and by the way, there are many variants now. People are adding more variants to it. You know, we talk of the, maybe people may call it environment. Others may choosing to talk of it from the economic point of view. So there's a variant that is already being added to it. With any knowledge, people always add knowledge to that. So with the environment, what we are saying is, how can we take care of the environment that we are operating in as businesses for future generations, which is very important. And I like to give a key example of plastics, where a lot of companies have become very conscious in the way plastics are being used and abused, you know, affecting things that maybe I may not never be able to see in the oceans. There's been, you know, oceans that have been damaged by plastics, the way we dispose of them. We talk of waste management under the environment. How is it businesses are looking at waste management. These are very important, critical issues. So when we come to the social dimension, she's already given a hint to say the social dimension of any business does not just resort to the communities around you. It also resorts within the company itself, the people that you are working with. When we talk of gender parity, we talk of inclusivity, all these issues become very important. Then we talk of governance, which is, I like the fact that you are an institute of governance. We talk of good governance. That construct for me is too broad and wide. We need to actually put matrices to it. How do we measure good governance? If we look at the dire situation with most developing countries with their state-owned enterprises, there's a dire, in fact, most of them are in the CU because of poor governance. These institutions, which are public entities, and they are the number one entities that provide basic services to the masses. So if we look at it from that context, we see that ESG should really become a key issue within government itself. Unfortunately, governments are lagging behind, unlike private sector, who seem to be taking the bull by the horns and really doing something about ESG. So from that context, I think it gives us some platform maybe to zoom in on some of these issues and how best we can actually conscientize government on ESG.
That's good. Steve, I actually want you to speak a little bit more, just unpack for me those three pillars a little bit further. Yeah.
Yeah, so it was quite interesting in many of the webinars that I've been on. There's been this debate about the three pillars.
Yeah.
And of course, the E is always mentioned first, the environment. And in fact, I'm on a website called ESG Today. And there are at least 20 articles every day, and 19 and a half of them about climate. The big E, the big capital E, climate. And that leads to the templates, which we'll talk about, and the frameworks and so on.
Yeah.
But there's this overriding emphasis on global climate metrics. The S gets sort of taken along the way. And the point that I made today in the session was that the S is sometimes much more important for economies like ours, where there are massive social backlogs. So the E is very important, but possibly more local E, local water pollution issues, etc., and impact on communities. But the S, as we all know, and all corporates in Namibia have focused on the S in their CSI. So the S has to be developed very strongly in our context. And we cannot be overridden by global climate metrics, because that might come at a huge cost to the social factors that we have to deal with in our countries, sectors, and companies. And then the G, of course, is extremely important.
Yeah.
And from a corporate governance institute, I support the views of those who say it should be the governance of the environment, the economy, another E, and the social factors. And an Indian participant actually raised that.
Yeah.
He said, let's call it GEES, not knowing that in Afrikaans, that's a great that's a great acronym for it.
Right.
But that was the emphasis, that we really need to build the governance of those other things.
Yeah.
And then depending on the context that your country or your sector or your company is in, motivate greater emphasis on one of those, but don't necessarily defer to these overriding climate issues, which are important, but the local issues are more important.
Yeah.
Let me just add what Steve is saying. Really, context matters for me, because we cannot take every template from wherever it is developed without really considering our own situation. So a template really plays a very important role, especially with things that he's talking about. We talk of climate change, but of course it has got an impact. Especially when you look at some researches that I've read, climate on women who are maybe in rural areas, climate on our conservancies, climate on our own weather patterns. So many things have been impacted by that. So it really needs to be looked at from a contextual point of view. Even the droughts that Namibia has been experiencing lately, they've come in a systematic way, and we need to really be looking at it from that context to say, as Namibia, how then do we look at climate change from our own context? Then I think we develop better frameworks to answer such issues.
Yeah, and Steve, I'm actually surprised we didn't mention the green schemes and the, the decarbonization and so forth in your examples. But yeah, that goes without saying in a sense.
Yeah.
And now I think we're now going to a little bit more theoretical stuff, which I think, and more technical stuff in a sense that, the principles that we're going to talk about are in a sense more theoretical and also more technical than just the definitions and the things that we've spoken about. So, the fiduciary role of institutional investors, demand that environmental, social, and corporate governance, ESG issues basically can affect performance of investment portfolios to varying degrees across companies. So obviously adopted per company, sector, regions, asset classes, and also through time. We also recognize that applying these principles may better align investors with broader objectives of the society. And so before we come to the investment aspect of it, Ishmael, I'd just like you to discuss what are those 6 principles of responsible investment, and then I can go to the investors. The 2 of them are in banking, so investment comes really easy to them.
Okay, so the first principle really looks at how we will incorporate ESG issues into investment analysis and decision-making process. Clearly, what it's trying to address here are the issues of the investment policy statements that needs to be drawn up. It also is assessing the capabilities of investment managers to incorporate ESG, which incidentally is part of the framework that I developed, having been looking at blue chip companies that are quoted on the stock exchange. So it has become very critical. How do these capabilities of the external investment managers incorporate ESG? Another important issue is how do we advocate for ESG training for investment professionals, which has also become a very important part of this first principle. The second principle looks at how we will be active owners, which is talking about ownership of ESG and incorporating ESG into issues of ownership policies and practices. So here what we are trying to say is, how do we develop and disclose an active ownership policy consistent with the principles, right? And how do people exercise their voting rights or monitor compliance with the voting policy? Do we outsource it? Is it done in-house and so forth? And also, how do we develop an engagement capability, right? Either directly or through outsourcing. So there are issues pertaining to that. I think nowadays, if you look at investments, there's what we call robo-advisors, especially for new investors coming up. So literally what robo-advisors are, it's really algorithms. All you need to do is to go on a computer. There's no person at the other end, but you've got small maybe income that you want to invest. And these people, through surveys, do assess you, and they give you direction to say, take this route with your investments, as opposed to big investors that really need a human touch to it. So we are talking about ownership. How do we take ownership with that? Sorry, I may need to flip my page here to the third principles because they're quite technical. The third one is, will we seek appropriate disclosure on ESG issues by the entities in which we invest? Very important. Disclosure issues are part of good governance. How do we then share information? What sort of information do we share? Remember, the big corporates are in a very competitive environment. Remember, at the same time, you want to give your shareholders, your equity holders, value and value for money. And that construct of value really speaks to what ESG really is all about. What value are we creating? Is it value for today or value for tomorrow? The fourth principle asserts that we will promote acceptance and implementation of the principles within our investment industry, implying that do we include these principles related to the requirements, for example, for requests for proposals. Let's say you've got some work that needs to be done. Are we already infusing ESG into these requests, which creates a sense that we are accepting that ESG is fundamental to even the works that we need to be doing going forward. Sorry, the fifth one, we'll speak to, will we work together to enhance our effectiveness in implementing the principles? This supports the participation networks and information platforms to share tools, pool resources, and make use of investor reporting as a source of learning. I just liked what Steve said earlier on, to say, even with governance, there are so many different aspects about governance globally. So to put these tools and resources on structuring something that can contextually apply, we need to see what others are doing. So when we pull our resources into a pool, we're able to collectively address relevant emerging issues, develop a support system which is appropriate and collaborative, and very important, with certain initiatives. And the last one is, we'll each report on our activities and progress towards implementing the principles. When we disclose how ESG issues are integrated within investment practices, do we sort of report on the progress that we have made with incorporating ESG? Do we disclose what is required from our service providers in relation to the principles? Do we communicate with the beneficiaries about ESG issues and the principles per se, which becomes very critical? So these are the very important 6 principles central to the way maybe ESG is being viewed in the investment arena. I think my colleagues can add more.
Yeah.
If I can just come in with a sort of a practical overlay, and a challenge again to the accountants. In 2018, Mervyn King and Linda De Beer, one of the King Committee members, published a book, and we actually hosted the launch here in 2019 of a book called Auditing Quo Vadis, What's the Future of Auditing? And they challenged the auditing profession then to reinvent themselves, because his theme has always been that the auditing profession only looks at financial capital, and the other 5 capitals are not being looked at. And they've certainly reinvented themselves in those 3 years. And these myriad of ESG templates that are coming out now from the auditing profession, because it's been given back to IFRS Foundation to come up with accounting standards for all 6 capitals now. But even before they're out there, and Ishmael, you hit the nail on the head when you name that big number, ESG assets would be 53 trillion. And there's a frenzy now around getting ready to sort of categorize and rank and rate ESG according to basic good principles, but not looking at the context. And that's why I'm so happy that the Good Governance Academy in South Africa on the 28th of June set up this ESG exchange to get the real practical experiences on the ground per jurisdiction, per sector, per company, as to what we should really be doing before we get subjected to these indices by rankers and raters who are looking at the financial again. You know, I'm worried that we've done all the right things to account for the real value created or destroyed in all 6 capitals. That's what we must be doing. But we're running after these big numbers that sort of attach to climate change and the energy transformation and so on. And there's already lots of what we used to call greenwashing happening around these pools of money, and people are already starting to misrepresent their ESG because there's no real clarity on the frameworks. And it's gone beyond greenwashing. It's gone to straight green fraud. And there are all sorts of cases being investigated, and people are getting fired and all that. So we've got to sort of take stock and look at our practical situations on the ground and work with the ESG exchange quite closely.
So yeah, and that's probably a good point, because that was going to be my next question, is that, you know, these principles are obviously voluntary and aspirational in a sense, and every entity, and we've mentioned this in the beginning of this program, that every entity needs to contextualize it And it's the outcomes-based, governance that we're talking about, where you don't just take a template and apply it as it is. You apply it to the conditions of your specific entity, organization, and so on. And so it's good that you've just spoken about those actions that need to be taken by investors or by companies or entities to ensure that we bring these principles into being. Are there any other thoughts that you may have regarding those specific actions that can be taken that bring to life the ESG in essence? You've also spoken about greenwashing and green fraud. And, actually, I want you to speak a little bit about more actions, if you think of any. And then I want to have you speak a little bit more about the greenwashing. What is that? Yeah. What it has now moved on to green fraud. What is that? Yeah. Speak to us a little bit more about that.
Yeah, all right. Well, let me start with those principles. Yeah. So greenwashing really came around when companies started doing integrated reporting according to the 3 Ps. And it used to be profit, people, planet. And then everybody said, but profit can't be at the top, it must be at the bottom. And then profit, in fact, became prosperity. So it was people, planet, and prosperity for all. And then under the 3P, triple bottom line, and then we added partnerships, because that's that's an honest broker, checks and balances, when you do it with people, with partners.
Yeah.
So people started sort of doing what they do and making as much money as they possibly could, and then spending what was called corporate social responsibility, giving as much back as you could. And the whole concept of integrated thinking, integrated reporting, was that you do all of those things simultaneously. You don't set out to make as much money as you can and then you do the others. They're integrated. That fed then in 2015 into the Sustainable Development Goals, the United Nations. And there weren't only 3 or 4 or 5 Ps, there were 17 Sustainable Development Goals.
There you go.
So then companies, even in the integrated reporting, would say, these nice icons of the 17, we put them next to our activities. And that became known as greenwashing. Sometimes it wasn't with ill intent. It was trying to match the real good things that we're supposed to be doing under SDGs with our activities. But it was sort of a bit artificial. And now we've moved to ESGs, where it's moved way beyond greenwashing. And I called it this morning green fraud. Yeah. Because companies are putting up their own templates, or exchanges, regulators are putting up templates that absolutely focus on global climate metrics. Zero carbon emissions, zero total emissions. And countries are starting to sign up to that through the COP processes, COP26, COP27. So there's huge pressure and incentives and disincentives to match up to all of these standards and the zero carbon emissions and all of that. So there's lots of money floating around to compensate people for making those contributions. And unless the accountants get on top of that quite quickly, we're going to have lots of bad practice in that. Whereas greenwashing was sort of okay, but making things look a bit better than they are. The green fraud that is going around this huge opportunity is an extremely dangerous territory that we're going into. So what we should be doing, Namibia started already. The stock exchange, our stock exchange already said all companies must have a subcommittee of the board, which they called, and this is important, they called social, ethics, and sustainability. The rest of the world is saying sustainability and environment comes first. Our stock exchange said social, ethics, and sustainability. And I think that leads us to the right focus, because it must be the social focus here. So already that's what they've done, and that's a great move.
Okay, so Steve, first of all, what do you think about that, the stock exchange stance on that, the naming of the committee? And what do you think about the fact that we already have CSI, committees in many of the boards? And how can we reconcile the two? Should it be under the one committee, or should it actually be divided between the two? Should we have them separately? And would you rather have had that naming regime being that of the global thinking, or rather the NSX?
I'll tell you what, when it came out, I said, no, sustainability is the big thing.
Right.
Social is the subset, like CSI is a subset. So I actually said it should be the other way around. And in MTC, in fact, we've done that. We've set up a sustainability, ethics, and social committee. In Gondwana, we have a sustainability committee that does everything. And there's no one model. Sustainability is such a key issue. You can make it a function of the board. But if there's going to be a committee, it's probably best, subcommittee, it's probably best to lump it into one. But it must not be on the side. It must be absolutely core to your business. And it must go through integrated thinking back into the integrated report. So I think it doesn't matter how you do it, as long as the priority is absolutely there. And as long as it's the local context of all of those pillars that you put up front.
And whether it's part of the CSI or whether it's a freestanding committee on its own.
CSI is a subset.
Just maybe
Ishmael?
just to add to what is maybe with the model of starting off with social, I think, as he has correctly said, it has to do with context, and we need to understand the context. If I look at that pillar of social, it talks to diversity and inclusion. It talks to employee welfare and development. It talks about poverty reduction.
Yeah.
It talks to CSI. It talks to health and safety. If I look at that, I also look at the countries. I'm looking at a better word, or where the country is at and where it came from, and how business can actually fit in supporting maybe some of government's developmental programs. So if you look at something like poverty reduction, to me it speaks to say, how then do businesses support government in its quest? Because Namibia is only barely how many years old from independence, and you look at the number of people around in the country that still may not have that opportunity to participate in the economy. So if businesses, like correctly Steve is saying, probably when we talk of social and ethics before we talk of sustainability, for me it makes sense. Because we look at where the country is at.
Yes, and now you've mentioned sustainability, which I was hoping to get to. Angelique, I'm looking at you. And a very big, part of this CSI and ESG is probably sustainability, or is it even a big part of it? And what do you think about sustainability generally? I know the sustainability reporting, and probably under that you find all these other things like CSI and ESG and so on. And we're really going into reporting now. So can you speak to us about sustainability?
Yeah, so I want to go a little bit back to what Steve just now said.
Yes.
And what we mentioned at the start. There's been so many of these terms, PPPs and now 4Ps and then SDGs and now ESG. And sustainability, I think, features in some way, shape or form in all of them. And that's why I wanted to say at the beginning, we must be careful of this buzzword story, because it just makes it another trend and it's going to come and it's going to go by again. So sustainability for me plays in all of them, right? Sustainability is key. Even when we look at CSI, we did CSI at RMB for many years, but it changed over time very much as how we look at it and how we approach it, because it doesn't help throwing money at a cause and then throwing money at the next cause. You're really causing more harm than good. It's really more about applying your mind that whatever you're doing creates a sustainable movement in whatever you're putting the money towards. And that's in the CSI side of things, right? In the ESG, there's a whole movement. And I think ESG has to be a journey. It's a transition. It's not going to happen very quickly. Companies in Europe and even South Africa are much further down the path than Namibian companies are. And it's interesting also what you said now, Steve, about greenwashing and green fraud and all of these things. We're seeing within, companies that want to invest in Namibian companies, that want to even put loans and debt here. They are looking for companies that are deeply entrenched in the ESG thinking already, but even they can't necessarily put their hands on yet which template are we following? What are we trying to do? You know, which boxes are we trying to tick? And we'll talk about the reporting, I suppose, in a little bit more detail. But sustainability and it making sense has to be part of this. And ESG to RMB might be, you know, the concepts and the pillars are the same, but the why is perhaps different than it is to MTC. And how one applies it and how you go about it and which one you take first or foremost is going to be different. I mean, in a bank perspective, we are anyway regulated and governance is high on the agenda, et cetera, et cetera. But even the governance in the ESG side of things isn't the governance that we're used to, the regulatory governance, right? It's the more responsible governance. But we are in this space, and I think at this time, more an enabler to help our clients become understanding of the ESG journey, being more aware of it, educating them, showing them how they can tick the various boxes depending on how it makes sense in their business. So to me, the why for each company is how it becomes something that they sustainably go on.
And sustainability also probably speaks about, you know, carrying on business in a viable manner, right? And not just in how they invest, but in all aspects of business, basically. So these are also key aspects of it. You know, you've mentioned that we've come from PPP to PPPP, fourth P, and perhaps moving to a fifth and a sixth and so on. And, you know, my question here really is this becoming onerous for you know, organizations? Is it something that, are we saying that all these concepts that are coming into play, and we've just mentioned, you know, the buzzword makes it more like an onerous thing, but is it really onerous? And probably, you know, draws down to the essence of corporate governance, because this is corporate governance. Is it onerous? Is it a tick box exercise per se, or is it outcomes based? And how onerous does it get for entities to even follow all these templates and agendas and all these things? Steve, what do you think?
Yeah, Vincia, it can become very, very onerous, and it really goes back to the progression of our corporate governance codes. And Mervyn King was the first to say that King 3 was mindless governance, and he apologized. He said, I'm sorry I brought mindless governance to all of you, because I had 76 principles which you had to tick off, and accountants loved that because it gave them work, but it didn't get to a proper outcome. So then he said, let's go to outcomes-based governance. And if you compare King 4 with King 3, which is NAM code, King 4 is not onerous at all. You scale it to the size of your company, to the nature of your company, and you apply those 4 outcomes. And I would like to see exactly the same thing happening in ESGs. But already we're seeing stock exchanges, regulators, IFRS Foundation, the Big 4, coming up with long lists of climate-focused benchmarks and targets. And they haven't even got to the others yet, so they're still on the E. And yes, there's going to be long lists, and it's going to be onerous, and it's going to be difficult. And I really hope that the Good Governance Academy under Mervyn King's leadership will apply the same type of outcomes-based, appropriate, contextual ESGs for companies on all scales, because you don't want people to say, that's just for big corporates. It's not for us. We want everybody to be in corporate governance, outcomes-based, and we want everybody to be applying the appropriate scale of ESG templates, rather than having international big check sheets that they have to go through.
Yeah, because these check sheets are starting to sound like we're regressing back to that mindless governance that we're talking about. It's definitely not what we want to do. It's just really too much work for entities to follow, and even to want to keep up with corporate governance generally. You just mentioned that.
If I can just finish on that.
All right, go ahead.
At the launch of the exchange, Mervyn actually put out a caution to the international community to say, listen to jurisdictions, look at their context. And don't start, he said, the raters and the rankers need to look at the real practical things on the ground before they build up big ESG indices and templates and things. And he actually put that warning to them to say, Look at context before you start punishing people or incentivizing them on a whole lot of criteria. So he's certainly speaking up for the developing world, knowing that the S is so important here, and the E issues, the big global climate issues, are important, but they're in the future for us.
And I think somebody mentioned that Africa is probably, it was in your session, that Africa, doesn't contribute so much to those E issues than it does to the S issues. So I think in that sense, contextualizing is very important. You mentioned that you would like to see, that governance is applied, and in that sense, ESG is applied by all types of entities and not just big corporates. How do you see this playing out with other entities? Because now with governance, we're not only talking about companies, we're also now talking about all types of organizations, meaning the churches, nonprofits, government, schools, clubs, anything. How does that happen practically?
I think it's the same principle as we're saying. Governance doesn't sleep. Governance is everywhere. And whether you're a school board or a church or whatever, you must have governance. You must have the same principles of diversity, inclusivity, and all of those things on any board, but you scale it to your organization. Yeah. And I think every entity, every governing body has some level of responsibility. Wise, definitely, environment, but socially, every single governing body has a social responsibility and has the responsibility to govern themselves properly. So I think it's just an extension of outcomes-based governance, that you have an ESG template which you apply appropriately to your organization, whoever you are.
Yeah, and I agree with that.
On that,
please.
So I think you're seeing, again, more so in the more developed world, but also starting here, and we can see it clearly. The corporates are also voting, I suppose, with their money now, right? So that's where the smaller businesses come in, because they're saying, I'm going to shape my ecosystem so that my suppliers, et cetera, are the right guys. And they're not looking yet for the tick boxes, but they're looking for the clients and the companies and the suppliers that are looking at social governance and all those kind of things, and where you at least thinking you're dealing with the right people. So you're starting to see the vote even in the business world by the corporate, which will affect that the smaller companies have to and will play in this space.
Yeah. Angelique, thank you. I actually wanted to go to you next, and you've spoken. I just wanted to talk to you about ESG reporting and how that impacts the future of financial performance of organizations.
So for me, ESG reporting is really just the output, right? And I'm going to go back to what I said earlier. The company has to decide, and this is where I still think in Namibia, in a more developing world, we still have a little bit more choice to say, this is how we are contextualizing this in our business. This is why we're doing it. And there has to be a deep buy-in, right? So the reporting is, for me, the output, the real reasons why we're doing it, processes and procedures that we put in place are then going to feed into what are we reporting on and why. And if I talk about reporting, I think it's also important to understand that we're still all grappling with this ESG thing, right? Yeah. And even in companies that think they're already quite advanced in applying it or talking about it or speaking with clients or stakeholders about it, the buy-in is fine, but people will just go about their own business if you're not going to say, right, these are the ways we're going to measure, the ways we're going to implement policies and procedures and what we want to do in this space. And even again, in a transitionary way, you're never going to put 20 things in place at once. Your people are going to be all over the show. Yeah. But if you say, these are the things we want to do and this is why, and you have a deep buy-in by your, obviously, executives and then people, then you can start putting KPIs to it very slowly so that the behavior changes. Because if it's not coming from an intrinsic place, it's going to just be a tick box.
Mm-hmm. And, that Ishmael, I want to go to you and say that ESG reporting obviously is at the backdrop of certain principles that have been developed by the UN Global Compact to help companies uphold their basic responsibilities to people and planet, and while supporting their long-term success generally. So I think the question I asked should have, I should have preempted it with this one to basically say, what are those principles? Because those principles of reporting will answer the question of how it really impacts, the organizations and their financial performance. And I'll also come to you, Steve, to just speak about that aspect of financial performance in a minute. But Ishmael, what are those principles of reporting? And just mention a few. You don't have to go into, I know there are about 10 of them, and you don't have to go into all of them, but just highlight a few of them to us.
Yeah, you caught me a bit off guard because I was just about to make a comment.
Please go ahead and make that comment before you answer.
I was just about to make a comment to the reporting, to say, look, reporting is good, right? It keeps an audit trail of how we are developing.
Right.
Reporting is very important. But the key issue surrounding reporting is it should not be more of a can type of reporting where regulators, if you look at ESG, sometimes the application right now where I see it mostly is on corporates or companies that really have got the capital muscle to really do the the investment in ESG. Not everyone may have the capacity, but there are small little things that the small companies can also do to aid the process of accepting ESG on their level. I think like what Steve was trying to say earlier on. So with reporting, I would rather not it be compelled or compulsory, but be encouraged at this moment in time because of our context. That's the view I may hold. Because if I look at international protocols like the SDGs we are talking about, those are very big issues that we're talking about here. And I look at emissions. I don't think Namibia is really emitting so much, green gases affecting the ozone per se, even if you look at the small population. In fact, I would rather call Namibia a victim of the bigger economies. So the reporting really needs to be messaged correctly across the board in such a manner that we need to look at who really are the participants that really have the bigger impact. Then we cascade it down to say, on your context base, on your size base, what is it that we require you to report on? To my mind, one thing that just came to my mind was when we look broadly at some ESG issues, I talk of emissions, or we talked of emissions earlier on. I look at what VW did some years back. I think they went and they lied about the emissions that one of their engine was causing, and this caused a global furrow that they to be penalized for it. So there is a lot of pressure now that is now associated with some of this reporting. And he talked about greenwashing. So it may lead to unsavory acts where companies now will start under-reporting, not reporting, or over-reporting on issues that more probably they may not be doing correctly.
Yeah.
All right.
But I think because of time, we might not be able to get through those 10 principles. But I think those principles are guiding principles in terms of reporting. What are those issues that need to be reported on, and so on. And so it probably also helps to curb or to be able to monitor how we report, what we report, and so forth, and the impact that it would have on our financial performance as an organization. And Steve, what does that, can you speak to me a little bit more about that impact on that future financial impact of an organization?
Yeah, look, we mustn't underestimate the benefits and the financial gains that one can get. I met yesterday with climate fund managers.
Yeah.
Our former Standard Bank CIB head, Amit Mohan. And these guys have access to lots of funding for those companies that are doing the right things. So banks who do green bonds will access concessional sources of funding and be popular amongst investors if they're doing the right ESG things.
Yeah.
So there's a lot of incentive to do this. One must just be careful, though, that you don't go and spend more money than you're getting out of the incentive pool to do that. And one's got to relate it to the the costs and benefits on a national scale as well. So we go as a country and we negotiate under Paris Agreement that we will, in our case, reduce our carbon footprint by 91%. I don't know where that number came from, but that commitment, I read yesterday when the UNDP ResRep said that was subject to funding out of these European global climate funds, etc. And the cost to that, the benefit that we would get, apparently, if we sign up to 91% reduction, is $5 billion US, which is 80 billion Namibian dollars, which is about 2/3 of our GDP.
Yeah.
So you're talking about huge amounts of money here to compensate or incentivize Namibia for doing the right things. Ishmael, your point is quite right. Namibia is a victim. We're a net carbon sink.
Yeah.
I gave the figure this morning. We are 0.01% of carbon emissions of the planet. Out of Africa is only 3%. But through the Paris Agreement, which set this all up, there is a compensation mechanism. And if we can start trading in carbon credits, and if we can get the benefits for doing what we do well, and if those benefits can flow through also to the social benefits, then I think we're on a good trajectory, and the deal will be beneficial for both of us. But if it's just us making the sacrifices for global climate issues and then getting paid a bit here and there, and that money maybe not going to the people who are making the sacrifices, then I think it's not a good equation. But if we can set up, and this is my final point, if we can set up an ESG investment sort of vehicle under the Paris Agreement where global investors can invest in ESG as a total, including building houses, clinics, social infrastructure, as well as putting money into the sort of climate mitigant area. But if they can put funds and they get credit in their jurisdictions for investing in these ESG vehicles, which are ESG in our terms, not just dominated by climate metrics, then I think we're on a very good wicket. And I hope that our government and African governments go to Cairo, COP27, and negotiate such a deal, because that will be a win-win situation.
So, Steve, now you also spoke about investments again. I think we spoke a lot about investment, and one of the reasons why we're doing reporting as well is because investors are, having a close eye on entities, how they are performing, and whether they are implementing some of these corporate governance principles like the ESGs and the CSIs, because these have become so important for investors to be able to invest in entities. So I see that terms such as green funds, social responsible investment, which is now SRI, impact investment, green investing, and fair trade investing are either associated or ancillary to ESG. And I think I'll start with you, Steve, and I'll go around here. And each of you just pick, one of the terms that I've mentioned and just speak a little bit about what that is.
Vincia, they all under this bucket, which has now been brought in as ESG, because it's been a fragmented, incremental process, and different people have called it different things. And I think it's high time that we do bring it under one umbrella. And what we're trying to do is get a sustainability reporting framework, which we happen to have called ESG for the moment, but that encompasses all of those things and accounts for your impacts on the environment, on society, etc., all the pluses and the minuses. And all of these funds and terminologies must be into that bigger framework and must be vetted and verified by accountants. And they must, like they've always done financial accounting, they must go to all the capitals and account for all your pluses and minuses in all the capitals. And these terms must be validated under that framework, because some of this is greenwashing. There's no question about it.
Okay. Angelique?
Yeah, so a similar point, I suppose. I also see them all playing into the same realm, really.
Yeah.
if you want to go by definition, there's a slight difference. For me, the green investment, green impact is more green funds are more where capital is then invested in the more greener parameters, whereas impact investment and fair trade is again different parameters, different definitions.
Right.
But ultimately, they have to and are all trying to achieve the same thing. It comes back to every jurisdiction and every company need to understand or need to create their own contextualization in this and make sure that they're doing whatever they're doing for the right reasons.
I think what also plays into all these terminologies is the issue of risk. I think we need to also associate risk with some of these to say, if we are talking about social responsible investment, what are the risks therefore associated with this? If we are talking about fair trade investing, what are the issues associated with that? So risk becomes a central, important part of it. And I always say that maybe from an academic perspective is most of these things need to be researched. Data speaks the truth. So when we collect data surrounding some of the issues that we're talking about so that we can contextualize them, then are we able to say what exactly really applies to our context, right? Because without data, sometimes we can allege and make claims, but sometimes that does not speak to what the reality is really talking about. Then incidentally, something that just popped in my mind when she was speaking to say, if we look at ESG per se, as it is being practiced, we tend to see it's more pronounced and prevalent in multinationals, companies that probably are not even home-based here. There are companies that are bringing it to us, wherever maybe the backyard where they're coming from is being compelled on them. So we tend to get offshoots of it, and probably, I don't know whether it's implemented to the fullest here, rather than back where it's coming from, where it's reported on. So we need to be wary of that to say, how then do we contextualize some of this ESG where not probably a big bank may be forced from a home country to really implement certain ESG and report on them, whereas here in Namibia, it's not more or less reported on. So there's also that issue. Then lastly, maybe as a sidebar, before I forget this, is that I think ESG gives us an opportunity. I talked about risk, and I'm thinking ESG really, with all these terminologies that we are talking about, really gives us a platform to innovate as a context.
Absolutely.
Really, what is it that we can innovate surrounding our own context with ESG? So we are saying we are taking care of risk. Risk is not really a bad chance. I think also risk is an opportunity that maybe we are not taking. What is it about Namibia that we really need to invest in as part of our ESG? So I think it opens doors for innovation, a way we can do better research, I think.
And go
Sorry.
ahead, Angelique. No, please go ahead. I was going to turn to you, though. Please go ahead.
Before you turn to, I think it's interesting to see, to the point that Ishmael just made, we're definitely, getting the pressure, if you want, to start doing more in the ESG space as the bank. And, the green or sustainability bonds type of things are definitely the easiest and most per se things that one can do. And we've had to explain to our shareholders and stakeholders, debt capital markets aren't as developed here as they are in the bigger South Africa, Europe, etc. But they are very different ways that one can still apply the principles in very different ways. Whether it's on the new reporting standards or accounting standards, whether it's on some of the environmental bits and pieces that you can do when it comes to carbon credits, which aren't developed here yet either, but there's a lot of talk about how to do these things. So I think while we have just raised a green bond and it was massively oversubscribed, which is great because it means that the energy is there for this. There are many more ways than just sustainable finance to apply this.
Okay, thank you. Steve, as a final point, do you have anything that you'd like to, say as a final remark, and then I would like to close this session?
So, we've talked a lot about the sort of climate override, and I think countries like ours, African countries, developing countries, must go to these fora like COP27, and we must commit to improving the health of the planet, even though we have been a very small contributor to the ill health of the planet.
Yeah.
We must commit to that. But we must insist that it's done in our context, one community at a time.
Yeah.
And community refers to villages, mines, towns, countries for that matter. We must do it from the bottom up, and we must not do it at the cost of social improvement and social upliftment. That has to be the core of what we do, because that's what our national plans say. And we can't now go and say, well, we're simply going to buy into this global metrics, which might undo some of our social plans. So it has to be gelled and merged with our national plans. And we must negotiate, because we're in a good position. We have looked after our part of the planet very well.
Yeah.
And we must be recognized for that.
Yes, I like that you ended with that, because I was literally thinking in my mind and hoping that you'd mention something about that aspect of social, that social aspect being key, especially in developing countries, especially here in Namibia. And I don't want to take away from what you said, because you said it eloquently, and I hope the right people have heard us. I hope the right people are listening to us. And that brings us to the end of our session tonight. So short and also so insightful. Very great to hear from all of you on this topic. Thank you so much, Angelique. Thank you, Ishmael, and thank you, Steve, for joining us tonight. I hope to have you on another session if we can. It's a second session for you, Steve. Thank you again.
It's my last.
It's your last. Okay, it's his last session. And thank you to our viewers tonight for tuning in. Hope to see you again next week when we're back at 6 p.m. Thursday and Central African time. Yes. Thank you. And good night.
Thank you, Vincent.
Thank you very much.
Thank you.